Good morning and welcome back to Finance and Money Matters. This is now episode 10. We've been away for a little while, so apologies for that. It's Monday, the 13th of October. We've had a lot of incoming calls about what's been happening in the US and the effects of the mini correction that we had on Friday and the subsequent bounce this morning. We're going to talk about the US shutdown and the potential impact on stock markets. We're going to talk about French politics, the UK's budget woes and what they can do, and generally about global rates. And then we'll have a talk about valuations, markets, earnings, particularly in light of banking results beginning to come through for Q3 this week. So let's touch on the US government and the shutdown that we're currently in. Does it matter? I think the long and short of it is it doesn't matter so much from a stock market investment point of view, certainly as long as it doesn't last for weeks and weeks, because then it would have a significant impact on a couple of key elements. The first of which is clearly in reality, there is a substantial civil service and government bureaucratic staffing level, which without activity will result in GDP decline. Some numbers we've heard about are something in the region of 1/3% in terms of quarterly GDP. That carries on for 3 months, which I doubt that would be the case. And then the other is that there are no data statistics being collected at the moment, and that has a significant impact on how forecasters can operate. Clearly, we are running blind at this point in time. The longer that goes on, the more concerned forecasters become. That's the kind of negative side. On the relatively neutral side, the Democrats and the Republicans have done this clearly before. We all know that. They've come to the table. At this point in time, the key issue is around the healthcare benefit system that is being reconstructed, and the substantial amount of low-end beneficiaries are being taken out of the system. The Republicans don't want to back down. The Democrats see this as a major vote winner. My suspicion is, and I think that this has happened before, is that there is going to be some kind of compromise, and the compromise will involve kicking the can down the road, that there will be a review of the welfare process and the cost-cutting exercise that entails, but not just yet. And so we are probably back in business again from a government perspective within the next couple of weeks, in which case there is virtually no impact on the economic environment from that. So that's why I'm kind of putting that to one side at this point in time. Clearly, what we've now seen since Friday is tariff concern back again. But this is an old playbook. Trump doesn't like the fact that China is imposing new restrictions on the export of rare earths minerals. And so he's immediately hit back with suggesting 100% tariffs on China beginning 1st of November, if not more, based on some retaliatory activities that China may put in place. But even through the weekend, they've stepped back from that. And that is the old play. Trump says something very aggressive, very controversial, and then proceeds to step back from that. The market got used to no tariff discussion and forgot about this issue, and on Friday resulted in this correction. Corrections are healthy, and we'll come back to that in a moment. The markets are overbought, and so corrections are helpful in this process. But is this the beginning of the end, so to speak, of this long in the tooth rally? I don't believe that is the case at this juncture. What I suspect is going to happen is that they will bring discussions back to the table again with the Chinese in terms of de-escalation, which is very much of a Trump exercise. And then I think that we start to look towards the next G7 meeting, where on the side, Trump and Xi will meet, despite the fact that Trump suggested that's not going to happen. So this is a blip, in my personal opinion, and I think that we will see further corrections because the markets are frothy and they will look for various excuses to take profit off the table. This is one of those, but this is a buy on the dip, not a sell on into weakness process. Moving on to Europe, It's very interesting that the French have taken a big hit in terms of stock market activity. The French economy is not generating sufficient drawdown from taxes in order to pay for the welfare state. This is a huge issue across Europe. We'll come back to the UK, but that's another major issue for the UK government as well. And for us, that implies that across the European Union, there is literally no more room for interest rate declines. We're at the 2% mark. There's nothing left in the bag. And so that actually then has an impact on risk assets and the ability to outperform it in a bottomed out interest rate environment. And as far as the UK is concerned, obviously we're looking forward, or maybe not forward, but to a budget at the end of this month. There is little room for maneuver for the Chancellor. The likelihood is that we continue to see a war being waged on middle classes and the business classes in terms of tax take. That is destroying growth and the opportunity to generate growth, but at the same time, the welfare state is burgeoning. This is not a long-term sustainable process. And so I believe, again, that despite the fact that interest rates are higher than those in Europe, there's again a restricted element of how much interest rates can come down, because borrowing and funding the budget from debt is going to continue to be a major exercise here. And so sterling has to appear to be strong. That can only happen if interest rates remain higher than the average levels of real interest rates that are around the world. So back then to the US, in terms of interest rates, what is likely to happen from here going forward for at least till the end of the year? I think there's still a room for another 25 basis point cut. Until we had statistics, the labor market was showing some level of softness, nothing to scream home about, but certainly a level of softness that we need to be aware of. There is potential for inflation to begin to tick up as the tariff impact begins to kick in, and consumer spending certainly showing signs of a slowdown. And we'll see when the banks report this week what their view is of credit quality in the consumer marketplace and demand, generally speaking. And so if there's a level of softness, that would certainly encourage more of an interest rate decline environment. When we move to think about what that implication is from a stock market perspective, clearly a falling interest rate environment, which the US is very much in, as opposed to Europe or the UK, that implies a move towards risk assets. And so the rally, in my view, continues until year end, at least, as long as we are continuing in a interest rate decline cycle, which I believe we are. That implies a weakening in the US dollar, which is positive for gold. The rates decline for the US implies, on a discounted cash flow basis, when you look at technology earnings, you can now discount less risk going forward. So duration risk reduces somewhat. The basic implication of that is that investors are prepared to pay more for long-dated income. And so that's positive for technology sector in general. So I suspect that outperformance continues and becomes more broad-based, not just within the Mag 7. A weaker dollar is clearly also very good for the industrial sector and the multinational businesses, where they're able to sell more and be more competitive abroad. And that is clearly resulting in a stock market that is currently looking like it's on some 22 times forward earnings. That puts it well above the 5-year average of around 19 times. Having said that, we have got a tailwind of some 9 quarters of consistent growth. This is probably the highest that we've had for certainly in the last 10 years or so. We've got earnings growth at the Q3 level in terms of forecasts of around 7%, consensus estimates, and for technology at 13%. So there is a significant opportunity for continued growth overall in terms of earnings. When we look at 2026, the consensus estimates for earnings growth for the market is 14%. The momentum is there in the US. The US exceptionalism is in place. It is not cheap. However, when we look at specific areas of the market, that is justified by that level of earnings growth. So we've got banks coming through this week. The banking sector's earnings estimate in terms of consensus forecasts are running at 12%. And for Q3 tech earnings consensus, it's actually at 21% year on year for Q3. So very strong earnings momentum, and we expect this rally to continue going forward. Today is Columbus Day in the US, so no bond markets, but we continue to see the equity market trading, so maybe more focus on the equity bounce back from the retracement of the tariff steps from Trump's comments on the close of Friday. We've got JP Morgan, Goldman Sachs, Citi, Wells, B of A, all reporting this week starting tomorrow and Wednesday and Thursday. So we're going to hear a lot from the sector. The earnings expectations are high. So let's see if this momentum can continue. Great to be back, and have a great week.